Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into FTAI Infrastructure Inc., FIP. This is a story of enormous potential growth locked in a terrifying race against the clock. FIP is betting that transformational EBITDA growth from its $1.05 billion W&LE rail acquisition and Long Ridge power monetization will be flawlessly executed, addressing the acute short-term liquidity problem where current cash flows are not sufficient to support the repayment of $1.55 billion of debt due in the next 12 months.
That thesis, it just captures the extreme pressure perfectly. I mean, what we're really observing here is a foundational stress test for an entire business model. FIP isn't seeking growth just to, appease shareholders. It needs this transformation simply to ensure survival and solvency.
So it's a high-stakes gamble.
Absolutely. It's predicated on achieving multiple complex operational and financial milestones without a single misstep. A true high-wire act.
Okay, let's unpack this high-wire act. FIP's whole identity revolves around operating these strategic, long-lived infrastructure assets, what they call forever assets. They have this diverse portfolio. It's broken down into 5 distinct segments: railroad, Jefferson Terminal, Repauno, power and gas, and a developing sustainability and energy transition piece. But you mentioned the $1.05 billion W&LE acquisition is foundational. So why is the rail business so central right now?
Well, it's the sheer scale of the opportunity and the immediate impact it has on their operational profile.
Yeah.
The acquisition of the Wheeling Corporation, a Class II regional freight railroad known as W&LE, it just gives them instant gravity.
And how big is that, really?
This one deal adds over 1,000 miles of track to their system. When you look at infrastructure, you're looking for a defensible strategic footprint, and, well, 1,000 miles of rail is exactly that.
A deal of that size, over $1 billion in cash. That's always going to draw regulatory scrutiny. They closed the deal, but what's the current status on full integration?
They've navigated the first hurdle, but you're right, they haven't achieved full regulatory control yet. The capital stock of Wheeling was transferred into an irrevocable voting trust.
When was that?
Back in August 2025. This is required while they await final sign-off from the U.S. Surface Transportation Board, the STB, which, regulates all rail commerce.
Oh, what's the pressure point on that timeline? Is there a hard deadline?
There is, and it's non-negotiable. The terms of the trust stipulate that it will automatically terminate on December 31st, 2027, if the STB approval hasn't been secured by then.
So 2 years? That sounds like a decent amount of time.
It does, but it creates this huge layer of uncertainty over an asset they need to fully integrate and optimize right now to hit their financial targets. It makes it harder to, pull those synergy levers aggressively until the control is absolute.
But strategically, if we just put the regulatory process aside for a moment, the operational synergy looks compelling. W&LE connects so smoothly to their existing Transtar operation. What are the key strategic upsides they are modeling for this combined entity?
The main benefit is robust diversification. I mean, historically, their Transtar business had this massive reliance on one customer, via steel.
Right.
Post-acquisition, the pro forma modeling suggests that reliance will drop dramatically to just 1/3 of the total rail business. And critically, the merger immediately brings on board 250 new customers.
250, wow.
It's a massive revenue de-risking move that, really justifies the strategic vision.
Okay, now let's get to the numbers that need to deliver cash flow right away. What is the financial target for this new rail behemoth? And how much execution risk is baked into that figure?
Management is exceptionally aggressive here. They've actually raised their own internal goal. The combined rail business is targeted to generate at least $220 million in annual Adjusted EBITDA by the end of 2026. That's a pretty big bump from their original $200 million estimate.
Hold on. $220 million annual EBITDA, contingent on realizing $20 million of annual cost savings within the next 12 months. That's almost 10% of the target, built entirely on immediate synergy execution. How much execution risk is really embedded in that $20 million number? It sounds like they're giving themselves almost zero margin for error.
It is an aggressive timeline, and it's a necessary risk. To realize $20 million in cost savings across 1,000 miles of new track and integrate it into Transtar in just 12 months, that requires rapid streamlining, optimizing maintenance, cutting overhead. This isn't theoretical future growth. This is operational discipline delivered under duress. This target isn't a nice-to-have. It's fundamental to providing confidence to the market and to potential lenders.
That focus on immediate synergy brings us directly to the overwhelming financial pressure FIP is facing right now. We can't talk about growth without putting the enormous debt problem front and center.
And that is the core conflict of the whole investment thesis. Management was pretty transparent about the severity of the situation. They concluded that FIP faced an acute short-term liquidity problem.
Meaning what, exactly?
The simple truth was that current recurring cash flows were just not sufficient to support the whopping $1.55 billion of debt maturities that were looming. They had to act immediately and dramatically.
And that brought on the Q3 2025 restructure. This wasn't just paying down debt, it was a multifaceted maneuver, right? It involved high-cost preferred equity.
It was a complex cleanup operation. First, they executed a major redemption, taking out $600 million of their 10.5% senior secured notes.
That's a high coupon.
Very high. But maybe more crucial was dealing with the equity structure. They redeemed $447.1 million of high-cost preferred stock. That preferred equity was a real headache because it carried significant governance rights.
So getting rid of it terminated that risk.
Exactly. Terminated that potential source of friction and control risk.
Okay, that sounds like a massive victory. Cleaning up the balance sheet, removing high-interest debt. But as you noted, you don't pay down that much debt without taking on new debt. What replaced that redeemed capital?
They essentially bought themselves time, but only a very short amount of it. The restructuring immediately introduced a 364-day, $1.25 billion secured bridge loan facility.
A bridge loan.
Exactly what it sounds like. A short-term solution to get across an immediate chasm.
And the maturity date for that temporary solution must be breathing down their neck.
Absolutely. It matures incredibly quickly on August 24, 2026.
A 364-day loan. That means they have less than a year, maybe 6 good months, to generate the market confidence to secure long-term financing. What is management saying about their top priority right now?
There is no ambiguity. Refinancing this bridge loan before year-end is the top priority for the entire organization. They have to convince the debt markets that the W&LE acquisition and the other optimizations are de-risking the business enough to justify a long-term capital solution.
You also mentioned a strategic decision about the remaining preferred equity, switching the dividends to PIK or paid in kind. For listeners not deep in corporate finance, can you explain why that move was a necessary evil?
Sure. It was a classic liquidity trade-off. By switching the dividends to PIK, they stopped paying cash dividends every quarter, which immediately conserved critical short-term cash.
But there's a downside.
Of course. When you pay in kind, you issue more preferred stock instead of cash. So this means that if they fail to refinance that bridge loan, they've increased the outstanding amount of preferred stock, effectively giving those preferred holders even more leverage over the company.
So they've turned it into a ticking clock.
That's a perfect way to put it, a ticking clock that amplifies the consequence of any financial misstep.
The message is clear. They need to generate massive cash flow, and they need it now, not just to look good, but to provide the collateral and confidence to refinance that huge bridge loan. This takes us out of the rail yard and over to the power grid. Is their power segment, Long Ridge, their most likely path to generating immediate cash?
It is definitely the most promising path to generating a large one-time cash infusion for deleveraging. The power segment centers on Long Ridge Energy and Power LLC. It's a 485-megawatt gas plant.
And they own it outright.
Yes. FIP achieved 100% ownership of this asset back in February 2025, and they have been optimizing it heavily, precisely because they view it as a monetization candidate.
How successful have those optimization efforts been so far?
Well, the targets are very high. They're pushing the plant to hit an annualized EBITDA run rate of $160 million in Q4 2025. Management has highlighted very specific, almost surgical improvements, like an $8 million software patch that they claim generates almost pure profit margin. These are the high-impact boosts that translate directly into higher valuation multiples for an eventual sale.
And the market for reliable power is obviously white hot right now, especially with the data centers. Does FIP have access to that surging demand?
Absolutely. That is the high-growth opportunity right next to the existing plant. The land surrounding Long Ridge has significant data center opportunities, which they estimate could contribute an incremental $50 million to $75 million in annual EBITDA.
Wow, on top of the $160 million.
Exactly. If they can secure contracts using that adjacent land, they are tapping directly into the massive insatiable demand for a highly reliable power from that industry. It dramatically increases the attractiveness of the whole package to a potential buyer.
So the strategic play is to polish this asset, hit the run rate, lock in data center contracts, and then put it on the market.
Precisely. FIP intends to pursue strategic alternatives for Long Ridge, including a potential monetization, a sale of the entire business. That means the gas assets, the power plant, and the surrounding land. And the importance of this can't be overstated. The proceeds from this sale would be available for further deleveraging at the parent level, which is the direct answer to that $1.25 billion bridge loan problem.
They need a successful sale to close the liquidity gap.
They absolutely do.
Okay, so while they line up that major asset sale, let's look at the rest of their development pipeline. The ports and terminals segment, Repauno and Jefferson. What milestones are providing high visibility growth that can help stabilize things?
We're seeing significant progress that reaffirms that long-term forever asset vision. The major milestone is at Repauno Port. They recently received the final permit for the Phase 3 underground storage caverns.
And that's a big deal.
This is massive because Phase 3 holds the potential to generate an incremental $100 million in EBITDA. It completely changes the scale of that facility.
That's a huge potential number, $100 million. But infrastructure timelines are notoriously slow. When can investors realistically expect to see that cash flow?
And that's the necessary caution. While the permit is a de-risking event, construction for those caverns is projected to take between 2 and 3 years.
So this is high value, high visibility future growth, but it does nothing to solve the August 2026 bridge loan problem.
Not a thing, correct.
So what about the nearer term at Repauno? What's already baked in?
Phase 2 development is already progressing well, and that is much closer to fruition. They already have signed contracts for Phase 2 that represent $80 million of annual EBITDA. So that's the near-term locked-in revenue stream.
And what about Jefferson Terminal? That tends to be more volatile due to commodity prices.
Jefferson is expected to contribute a solid $25 million of long-term annual EBITDA from new contracts that start in 2025. That growth is highly dependent on volume ramp-up, of course, crude and refined products.
But when you add that $25 million to the $80 million from Repauno...
Right. You start seeing the foundational non-rail growth take shape.
Okay, so if we synthesize all this potential growth, the synergies, the optimization, the development pipeline, the picture painted by FIP management is quite rosy.
It is, if they execute. FIP is targeting that $220 million rail EBITDA run rate. Plus, we've outlined at least an estimated $190 million of incremental, locked-in annual EBITDA from its development assets. The pipeline justifies an ambitious valuation.
But the investment thesis remains perpetually overshadowed by the immediate financial reality we started with. The potential is massive, but that clock is definite.
Absolutely. The pipeline is critical, but the financial stress is acute. I mean, the market can't ignore the fact that FIP posted a Q3 net loss of over $104 million. That loss starkly illustrates the difference between asset potential and current operational earnings. And that number pales in comparison to the immediate pressure to refinance the $1.25 billion bridge loan maturing in August 2026. This isn't optional growth. This is mandatory debt management.
So what's the final verdict here? Is this a high-reward growth story, or is it fundamentally a high-risk debt play?
It's defined entirely by the execution risk. This is a high-stakes gamble on absolutely flawless operational execution under extreme financial duress. The growth targets are visible, they are substantial, but the deadlines are unforgiving. This is precisely why Moody's assigned a B3 negative outlook. That level of growth we're seeing is the absolute minimum required for stability and survival.
So failure is not an option.
Failure to secure the long-range sale or failure to refinance that bridge loan fundamentally breaks the entire financial structure.
It's a fascinating, if stressful, challenge. A company with this strong foundation of forever assets balanced against incredibly tight financial deadlines imposed by high-cost, short-term debt. They bought themselves a few months of liquidity by switching those preferred dividends to PI, but as we discussed, that just amplified the leverage held by those preferred stockholders if execution falters.
Right. It forces investors to ask the ultimate question. Can the visible growth runway, specifically the W&LE synergy and the long-range monetization, be successfully converted into sufficient liquid cash before the financial time bombs detonate?
The bridge loan maturity and the accrued preferred equity term.
Exactly. It's a literal race against the clock, and the only path to success involves a flawless relay. Risk defined, portfolio protected,